Okay, all right. Thank you for watching this channel. I'm going to be sharing something very, very interesting and exciting, especially if you're a forex trader. So I want you to listen attentively, watch this video, and make sure you watch it to the end because I'm going to be showing you how to catch a lot of pips from gold. So, and I want to show you how you can get a sniper entry from gold. I want to show you how to get a sniper entry from gold and how can you spot a reliable entry so that you will not be able to you will not have a very big drawdown. So it will help you to at least you're going to be having a lot of profits and less drawdown. So that's what I'm going to be doing for you right here. You can see what I'm doing now. You can see, okay. How does this setup started? How does it started? That's the first thing we are going to be doing. So how do you spot it? How do you get a sniper entry? How do you enter the market? How do you analyze the market? What are the criteria that you need to see before you enter the market, and how do you manage your trade? So first of all, let's go with the analysis first. Now, so what you normally need to do if you want to analyze a forex trading market is to go to the higher time frame. You know, the higher time frame started from monthly. Okay, let me bring it out. This is monthly. You can see this one is monthly, this one is weekly, this one is daily. This H4 means 4 hour, this H1 means 1 hour, this M30 means 30 minutes, this M15 means 15 minutes, while this M5 means 5 minutes, and M1 means what? Means 1 minute. So but before you are going to be using all this smaller time frame, 1 minute, 5 minutes, 15 minutes for entry, while you are going to be using this MN, which is monthly, weekly, okay, so you are going to be using monthly, weekly, daily, 4 hour for your analysis, at least to get the trend. Number one, to get the trend. Number two, to mark your key levels. So number three, and also to know the direction of where the market is going. So I'm going to be talking about that now, right now. So let's quickly move on. Now, you want to start the analysis, and if you want to start the analysis, what are you going to do? I told you are going to be starting with higher time frame, which is monthly. So if you take a look at gold here now, you can see that gold is coming from a very all-time high. It's coming from a very all-time high. Gold has been bullish throughout last year. Yes, gold has been very, very bullish throughout last year. And if you are not very careful, following that bullishness, you may not know when the market will crash, and you just see a sudden bearish move, just like what happened here. See what happened there. See what happened on daily. Look at that bearish candle, that red candle, that big red candle. So look at what happened there. So if you are not very careful, so you won't know when that sudden fall will occur. And that is why you need to be very, very careful when you are trading gold, because gold is one of the most volatile currency pair. So it's one of the most volatile pair. So though it belongs to commodity, and that is why you need to be very careful. So now, as it is now, you can see this is daily, and we all see that the market has been bullish for a very long time. You can see the swing low, the swing high, you see the pullback, you see the move, the impulse move, you see the retracements in the daily, and you can see what is happening there. Now we now want to find out why sudden pullback, what makes gold turn back from that selling, from that bearishness? What makes it to turn down from this level? You can see, if you take a look at this, there is something we call fair value gap. That fair value gap can be spotted immediately after this swing high, because market normally respects fair value gap a lot. And if you take a look at all these candles, you will notice that there is no, the fair value gap means the gap, it means an imbalance or inefficiency between three candles. And the gap I'm talking about now is that, let me analyze it for you so that you can see it. Is the gap between, I'm considering this candle that I underline on top of it. This is the second candle here, and this is the third candle. So this is the first candle, second candle, and third candle. Now I want to consider the gap between the three candles now, and that is what I'm going to use. That is what we call the imbalance, the inefficiency, because in that zone there is a solid move, an aggressive move. Market move in that zone and leave behind an inefficiency. You can see the other, if you take a look at the other candles above, you can see the candle, those candles, they have what we call wick. The wick touch the other candle, so there is no much gap between them. So like this one also has imbalance. This one also has fair value gap here. But we are considering this gap that we see here. You can see the gap between the last candle and the upper candle.